I'm pleased to be here with Jim Melcher, the founder of Balestra Capital. This is our first interview for a new series for Tiger 21. Jim, thanks for being with us.
Thanks for inviting me to join in.
You're a bit of a sage. How does it feel to be in the middle of all of this and to be one of the handful of people who is credited with having seen it before anybody else and still in the middle of it?
Well, it makes me a little nervous, to be honest with you. But I in the first 20 years, and my associates and I since, have pretty accurately predicted every major downturn in financial markets over the last 29 years and proactively protected our investors. Certainly with the high-tech collapse, we were not the only firm who understood that we're in a bubble that would collapse. Rating agencies, underwriters, investors were assuming that the standard for home mortgages that was in place for 60 years after the Second World War would maintain itself, and that was that people would not let go of their homes under any circumstances if they possibly could keep them going.
Right.
So mortgages were the safest of all vehicles. But a couple of things changed. Home prices were appreciating very fast, and historical valuations were exceeded by an enormous amount. Historically, for a period of over 100 years before that, home prices in real terms, inflation-adjusted terms, did not change. Only really about 15 years ago did they start to rise. And in the last 7 or 8 years, up until about a year and a half ago, home prices went up about 75%. So people were buying homes at inflated values, but those inflating values made them think that these were profit-making opportunities as opposed to just homes. And also it panicked the people who were waiting to buy a home that they'd better buy before it went higher. It also caused people to buy a bigger home than they could otherwise afford because concomitant with this, and part of the reason that prices rose, was that interest rates had plummeted starting in 2001 when the Fed cut rates sharply to avoid the full effects of a recession. 2 years ago, the default rate was at historically low levels. But there are reasons why one should have looked through that and questioned it. You know, why would anyone default on a mortgage when they could just turn around and sell the house for a profit or just refinance and take money out and pay down the old mortgage? So of course the default rate was low. That was a danger sign, not a sign for complacency.
So maybe we can go back to just some basics. Could you just explain what a CDO is and a CDS and how they relate to your business?
Yeah, a CDS is a credit default swap. CDO is collateralized debt obligation. RMBS, residential mortgage-backed securities, and various other securities like that. These are all derivatives. A derivative is a financial instrument whose price is determined by the price action of another security. So puts and calls are the perfect example. They've been around for 100 years or more. And the price of a put or call is determined by the price of the underlying stock. In the case of credit default swaps, specifically the word credit is what's key here. It's based on credit in the credit markets, and these are debt instruments, bonds. And so if someone wants to buy a bond and they're maybe a little concerned, or they have a bond portfolio, some smart people on Wall Street just a few years ago thought up the idea of insurance against loss on the bond portfolio. And they came along and said, look, for 30 basis points a year, 1/3 of 1% per year, we'll insure your whole bond portfolio against default. So with a $100 million bond portfolio for $300,000 a year, if any bond in here defaults or there's any other negative credit event like that, we will pay you the full price of the bond. And that was attractive and a useful instrument to bond portfolio managers because for a very small amount it gave them the security that they wanted. Because if you're buying bonds, you're looking for security. As time went by, just 4 or 5 years ago, and increasingly over the last 3 or so, credit default swaps became something else. They sort of evolved, or morphed, if you will, into gambling chips, because there were investors who thought, well, wait a minute, I can buy a credit default swap on a bond I do not own. And they realized this was a way to bet on whether bonds are going to go up or down. It also opened the door to create synthetic bonds. So someone who would normally buy a bond, maybe he wants to buy $100 million of a particular corporate bond, and only to find that if he did that, he'd affect the price. By buying it, he'd run the price up, and he'd get less yield. But the big investment banking firms realized that this was a very good new business for themselves, especially by about 2.5 years ago, when corporate bonds became relatively scarce. And you could tell that by the price, because the amount of interest you could get over treasuries, the gold standard, narrowed into the point where it hardly paid. And certainly if you're going to buy $100 million worth of a bond that was selling, say, at 40 basis points over the treasury of the same maturity, you were going to end up getting only 15 or 20 basis points because you'd run the market up in the course of your buying. But your handy neighborhood investment banker says, hey, we'll sell you a synthetic. So they sell you a credit default swap, and what you have there is you as the bond buyer, instead of buying a bond, you buy a synthetic. You say, all right, I'll agree with this contract I'm signing, this credit default swap, that if there's a default or any other negative credit factor on this bond, I will pay the other side of the trade and make up the difference. And the other side of the trade, though, has to pay me 40 basis points a year for till the maturity of the bond.
So specifically, credit default swap is a way essentially for investors to become insurers. They're almost like an insurance company for the bond owner, because they're now taking some of the risk that the bond owner wants to shed. And if it's not the bond owner, then they're just trading back and forth, as you say, on one side or other of the trade.